Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews where we bring in someone who's got something interesting to say about the markets, the economy, whatever we think is interesting at the moment. And you couldn't get more volatile and interesting than what's happening on global currency markets and stock markets over the last couple of months. And so we've brought in Chris Weston from IG Markets to talk about what's driving international markets, currencies over the last couple of months and what we can expect in the next couple of months. Chris, what are you seeing particularly around currencies and interest rates globally at the moment? What's moving things?
Well, I mean, if you're looking at the risk currencies, obviously sterling, euro, the Australian dollar, the Kiwi dollar, they've been driven by the risk that's coming in the market. The fact that there's not a huge amount of volatility, even though perhaps there should be, given what's being thrown at the markets at the moment, they're doing very, very well, and it's the perfect conditions right now for carry trade to be put on, and that's why the Australian dollar's doing very well. That's why the New Zealand dollar's doing very well at the moment. People are obviously selling out of the low-yielding currencies, the dollar, the Japanese yen, and looking to buy the high-yielding currency and looking to buy those treasuries and the underlying market there as well. So that's why we're seeing really good bids, and the Aussie dollar's obviously pushing up to 105. The euro is actually the second best performing currency this year behind the Norwegian kroner, which is up about 6.5%.
Why is that? Because we've got this European sovereign debt crisis going on at the moment.
People don't care about the sovereign debt crisis. Now, if you look at the three countries which are obviously now getting bailouts and tapping the European Financial Stability Facility, which has been put in place by the EU and the IMF, Greece and Portugal now, and Ireland obviously now. Portugal came out and tapped aid recently. I think they're looking for about $80 billion. The big elephant in the room is Spain. Spanish yields haven't actually been pushing. They've been relatively flat.
Why is that? Because it is the one that everyone's worried about.
It is. I mean, they've obviously got a very high youth unemployment situation there at the moment. But the banks seem to be, well, apart from the most of the banks, they're actually reasonably well capitalised, and there's not a huge systemic problem coming out of Spain at the moment, and their yields are actually been plateauing and been relatively flat, while Portugal's yields have been really hit quite hard by the bond vigilantes, and obviously as a result of those high yields, it's very expensive for them to roll over their debt, of which they've lost, and they've obviously had to go to the EU. So we've got those three different countries which are now being contained, and they're tapping the funds from the EU and the IMF. The other countries are actually above trend growth, and basically people are looking at interest rate expectations, and that's the key situation that's been coming through. What happens now? We've obviously seen a 25 basis point hike by the ECB. What happens going forward? Well, as it stands, there's about 133 basis points being priced into the euro over the next 12 months. So that's about 5 hikes that the ECB have got to do.
Can the European economy handle that, though? I mean, if the ECB puts up rates to 2.5%, 3%, how are the fringe countries going to handle that?
Yeah, I mean, that's a very good question. You've got this disconnect between what the credit markets are pricing in at the moment and actually what Jean-Claude Trichet came out and said the other day, which is potentially that we're not going to see a series of rate hikes. And that, for me, is why we could possibly see a bit of downside. The European economy the ECB is there really probably to service Germany. Germany's still very, very strong. France is another core nation, which is still quite strong as well. And that's what it is. The euro is there basically to look after Germany. And, I think they've got a clear inflation problem. The ECB's mandate is to look after inflation and price stability. They don't worry about anything else. And inflation is a problem. They've got 2.6%. They want it below 2%, and they feel the best way to do that is raising rates, whereas the Fed aren't really seeing those kind of dramatic situations. So we have a situation at the moment. Potentially, there's too much being priced into the euro. We could see some downside from here.
Now, the Fed, a very interesting situation in the States right now, because the Fed is about to finish off pumping money into the system with its $600 billion bond purchases, and it still doesn't look to be moving that Fed funds rate up from nearly zero. What's the outlook there?
Well, the Fed funds rate's actually now pricing in about a 50% chance that we're going to see rate hikes, and that's a separate situation from the liquidity measures you're talking about by January. So that's interesting. I personally believe that the Fed will be looking to hike probably mid-2012. I don't think the Bernanke's alluded to any kind of situation where they're going to be putting rates up anytime soon. What happens now? Well, there's 3 scenarios. Do we see an early finish of the QE2 package, which I don't think is going to happen at the moment? Last time they did that in the first QE1 package, we saw the markets, the S&P dropped about 12%, the dollar firms and treasury yields dropped from about 3.6% down to about 2.8%. They've learnt their lessons from that. Do we get a third QE3 package? No, I don't think we're going to get that. If we do, I think the markets will sell off whilst we're getting more liquidity, which is positive. Markets could sell off because you're in a situation where the Fed are saying, well, we know the economy better than anyone else, and it's not robust enough, so we're going to have to probably come out and put more stimulus. So that's another contrarian way of looking at things. So I think they'll finish their QE2 package in June, and they'll keep liquidity in the system, and they probably won't look to withdraw liquidity until perhaps the end of the year. But the Fed, they're in no rush to be doing anything at the moment.
So that's currencies and central banks. What about stock markets? Because they just seem to be going up and up and up. How long can that last?
Well, I mean, they've had a pretty good run. All markets. I don't really follow the New Zealand market, to be honest, but all the major markets that we look at have had a very, very good run. Valuations are still not particularly stretched. If you look at the ASX 200 right now, we're still on about a 12% discount to the long-running average of a PE. So means we're not overly stretched, but we've had a very, very good run. What we've actually seen in global markets, especially in the S&P, is money being taken out of fixed income funds, money being taken out of emerging market funds and being placed into mutual funds in the US. That's the funds that invest into US equities because of the growth prospects of the US, and also because we're going to see liquidity being brought out of the market. Yields are expected to push up, and as a result, people are now just buying into equities.
This is what happens when you push interest rates down. You push people out into the riskier assets.
So that's another thing. You've got low interest rates at the moment. In fact, you've got negative real rates because inflation's above the actual. If you get the overall interest rate minus inflation, you've got a negative number effectively. And companies in that sort of environment have huge amounts of cash. In Australia, we've got about 181 billion. In the US, they're sitting on about $2 trillion worth of cash. That is killing return on equity for the companies. That's why we're going to see for more M&A activity. You look in Australia at the moment, we've got plenty of that going on. I believe that's just the start of what I can name about 5 or 6 different companies which potentially the Chinese are going to look at very strategically, and that's potentially going to be another driver, a continued driver of US and the ASX going forward.
Big deal in the last week, the Chinese company Min Metals bidding for Equinox, listed in Perth, owns huge copper mines in Africa. Mm-hmm. How much of this activity, Chinese interest in Australian-owned minerals, are we going to see?
I think we're going to see a lot. Basically, China are going to look at strategic assets. They're not going to. They want more, base metals. They want more iron ore. They're still rebuilding. Despite all the slowdown we're seeing, there's still a huge amount of rebuilding. Now, Equinox as a company is a fantastic company. There's no doubt about that. The mine that they've got, Lumwana in Zambia, is a fantastic tier 1 asset. And as a result, the Chinese are looking at that going, huge expansion plans, huge development through the pipelines coming through. We want these assets. So there's a number of other companies. People have talked about Woodside Petroleum potentially being one. I think BHP is the obvious take out there. Fortescue's been touted, companies like Illumina. There's a few other companies who do have assets of strategic importance to the Chinese, and what the Chinese want they'll get because they've got very, very deep pockets and they'll beat any corporation at the moment.
Now, the other issue that's happened in the last month or two is the extraordinary earthquake and tsunami in Japan. Mm-hmm. What impact has that had on the global economy and global markets? Or is it one of those things, a couple of weeks of obvious drama in Japan, but not necessarily a disaster on global markets?
Well, it's not going to be a disaster on global markets, and obviously you can't take anything away from the tragedy that happened over there. But Japan, as a percentage of global GDP now, makes up a reasonably small percentage. I think in '95 it was about 18% of global GDP. It's now about 8%. So its impact is a lot less. And obviously we've got the rebuild process that's going to come through, and that's why we've seen a lot of the commodity stocks in Australia doing very well on this potential rebuilding process, which we know is about $300 billion at the moment. So I think its impact has been relatively subdued. Obviously, we saw G7 intervention in the currency markets, which has obviously weakened the yen quite considerably, and it's going to benefit their exporters going forward. So I'm pretty optimistic on Japan. I'm optimistic on China going forward, and the Chinese market, especially the Hang Seng. And I think that's going to breed further confidence in the market. But at the end of the day, what we saw is a 20% drop in the Nikkei straight away in 2 days. I mean, it was fantastic. It was horrible to see. But fantastic trading opportunities around that. People were acting on emotions, and when you see that scenario playing through, that there's some good opportunities to come through. So longer term, I think the Japanese rebuild process will be very positive. Dollar yen's a currency that I look at very closely, and I'd be expecting that to potentially push up to 90 by 2012, even if it's on its way up to 100. the internals of the way that they fund treasuries in Japan is fundamentally broken to me. They've got an ageing population. We know that every demographic tells you, and they actually fund their internal deficit by buying JGBs, Japanese government bonds. The young people don't want to be doing this. They want to buy equities. They want to buy high yielding assets, and as a result, they may have to monetize debt. So longer term, I believe dollar yen is one that you can look at. I believe the yen is structurally quite flawed at the moment.
Interesting. Chris Weston there from IG Markets. Chris, you've been to Wellington. A lot of New Zealanders interested in what's happening on markets. And tomorrow you're speaking at the Langham in Auckland on Saturday morning at 10 a.m. Lots of juicy stuff about currencies and markets.
That's right, yeah. I mean, if you're interested in markets, you want to learn a bit more about potentially where we see things going, some of the flows that we're seeing within the company, they come along.
Excellent. Chris Weston there from IG Markets. That was another in our series of double shot interviews here on interest.co.nz.